In this segment, we will look at the impact of basic business transactions on the accounting equation. With an understanding of the accounting equation, we have to remember that the equation must always stay in balance. In other words, the company's assets must always equal the company's liabilities plus the owner's equity. That means every time we change one item in the equation, something else needs to change as well. For example, the owner invests $20,000 cash to start a business. So in the business's general ledger and the business's accounting records, we will record an increase to the cash and we will record an increase to the common stock because as the business received the cash, it gave the owner a share of stock in exchange. Cash is increased, causing overall assets to increase. Total assets are $20,000. Equity increased $20,000. Total liabilities plus equity equals $20,000. Assets of $20,000 equal liabilities and equity of $20,000. The equation is in balance. The next transaction that occurred, the business purchases supplies using $1,000 in cash. When this transaction occurred, the company cash went down because they used cash to purchase supplies, and the amount of the supplies they own went up. Cash is an asset, supplies are an asset. So we need to go into the accounting records and decrease cash to reflect the fact that they no longer have $20,000 in cash. It has decreased $1,000, bringing cash down to $19,000. The amount of the supplies increased $1,000, so that account is increased $1,000. Cash of $19,000 plus supplies of $1,000, total assets of $20,000 equals total liabilities plus total equity of $20,000. Notice that we only affected one side of the equation, but the equation remains in balance because one account increased and one account decreased on that side of the equation. Next, the company purchased equipment, $15,000 in cash. Again, cash is decreasing because the company used some of its cash, so we need to decrease cash, bringing the balance in cash down to $4,000. Nothing happened to supplies, but equipment is increased $15,000. Total asset account balances, $20,000. Nothing happened on this side of the equation. It remains at $20,000. Equation remains in balance. The business purchased $200 of supplies and equipment of $1,000, both purchases on account. On account means they have made the purchase, but they haven't paid for the purchase yet. That means they have a liability to pay for those purchases at some time in the future. So we know that the amount of supplies the company owned increased, so we're going to increase the supplies, which is an asset. The amount of equipment the company owns increased, so we're going to increase equipment by $1,000, bringing total assets to $21,200. Liabilities, accounts payable, reflecting amounts the company owes for normal day-to-day purchases. That liability increased, bringing total liabilities to $1,200. Total liabilities plus equity, $21,200. Our equation is in balance. Assets equal liabilities plus owner's equity. Pay attention. Every time a transaction is recorded, at least two accounts will always be affected. This is the only way the equation will stay in balance, because if we increase one account, another account needs to increase or another account needs to decrease. The next transaction, cash of $4,000 is borrowed from the bank. The company borrowed cash, so the cash went up, so we need to increase cash in the accounting system to reflect more cash on hand. Liabilities went up as well when we borrowed that cash. We now have to pay back that borrowing. Because borrowings typically involve the signing of a promissory note stating interest will be paid, we are going to keep track of that liability separately from accounts payable. So we're going to record it in notes payable. Total liabilities plus equity, $25,200. Total assets, $25,200. The equation remains in balance. Notice that these balances that we are starting with in this slide were carried forward from the prior slide. The next transaction occurred. Consulting services of $3,000 were performed for a client, and payment was received immediately. The company has provided a service, which means they have earned a revenue. They have made a sale. Recall that revenues impact the owner's equity. The amount of revenues earned have gone up, so we are going to increase the revenue account. And because we received cash right away, cash also increased, so we need to increase our cash asset account. Total assets of $28,200 equal total liabilities and equity of $28,200. Equation remains in balance. In this transaction, employee salaries of $800 are paid. Employee salaries are an expense to the business. They are a cost of operating. Because cash was used to pay those salaries, we need to decrease cash, and we need to record the amount of expenses or costs that were incurred. Recall that expenses are an equity account. We are going to record an increase to the expense account. As the amount of expenses recorded increases, they cause overall equity to decrease. So it may look here like we are decreasing the expense account, but those parentheses are a way for us to remember that as the balance or the amount of expenses recorded increases, these expenses decrease equity. So if we add up our assets, $27,400, liabilities plus equity, $20,000 plus $3,000 in revenues, less $800 in expenses, total liabilities and equity of $27,400. Equation remains in balance. Finally, some of those profits, or the difference between revenues and expenses, are being paid out to the owners or the shareholders in the form of dividends, $500. That means the company is using some of its cash, so we need to decrease cash in the accounting system to reflect cash being used. We need to record an increase to the amount of dividends that have been paid. Notice again, similar to expenses, the balance in the dividend account is increasing, reflecting more dividends have been paid. As the balance in the dividend account increases, it decreases overall equity. Dividends and expenses act the same. The greater the amount of those two items that are recorded into the accounting system grows, the more they cause equity to decrease, which makes sense when you remember that equity is affected by owner investments. Equity increases as owners invest. Equity increases as the company earns revenues, but equity decreases as costs are incurred, and it also decreases as dividends are paid.